Navigating the United States healthcare system requires treating it as a personal finance and wealth protection issue. Without a strategy to manage these expenses, routine medical care can quickly erode long-term savings. Data from KFF shows that nearly 1 in 12 adults in the U.S. currently carry medical debt. When we examine the demographics, women make up a disproportionate share of that group. This gap is driven by specific life events and health requirements. The high out-of-pocket costs of childbirth create significant early liabilities, while women are also statistically more likely to manage chronic conditions that require regular monitoring and prescription medication. A major part of this burden comes from a knowledge vacuum. 43% of women report receiving unexpected bills for standard checkups, often because they were unaware of the specific billing rules for lab work or out-of-network providers. To protect your assets, you have to move beyond the role of a reactive patient. Safeguarding wealth in this system requires becoming a proactive strategist who understands specific tax tools and federal legal rights. The life cycle of healthcare protection begins during open enrollment. This is the critical window where you select the tools that define your financial liability for the coming year. The centerpiece of this planning is the Health Savings Account, or HSA. To unlock this account, you must first be enrolled in an HSA-eligible high-deductible health plan. An HSA offers a triple tax advantage. You contribute funds on a pre-tax basis, which lowers your taxable income. Those funds can then be invested, allowing for tax-free growth. Finally, you can withdraw the money tax-free to pay for qualified medical expenses. This differs from a flexible spending account, or FSA. While FSAs typically have a use-it-or-lose-it penalty at year's end, HSA funds roll over indefinitely. The account is yours to keep, even if you change employers or health plans. For the 2026 tax year, the IRS limits contributions to $4,400 for individuals and $8,750 for family coverage. In 2027, those limits rise to $4,500 for individuals and $9,000 for families. If you are 55 or older, you can contribute an additional $1,000 as a catch-up allowance. Fully funding an HSA transforms an unavoidable household expense into a tax-sheltered investment vehicle that can be used to cover healthcare costs well into retirement. While planning builds your reserves, your legal rights protect those reserves when you actually enter a clinic or hospital for treatment. A common financial risk occurs when you visit an in-network hospital but are unknowingly treated by an out-of-network specialist, such as an anesthesiologist or radiologist. This leads to balance billing. The insurance company pays a set amount, and the out-of-network provider bills you for the difference, which can result in thousands of dollars in unexpected debt. Under the No Surprises Act, this practice is largely banned. Federal law shields insured patients from emergency balance billing and out-of-network doctors at in-network facilities. However, you must be careful with notice and consent waivers. Hospitals may ask you to sign these to waive your protections for post-stabilization services. You should never sign these forms blindly, as doing so voluntarily surrenders your legal right to in-network pricing. For those who are uninsured or paying out of pocket, the law requires a good faith estimate before treatment. If the final bill exceeds that estimate by $400 or more, you have the right to dispute the charges through a federal resolution process. Using these federal protections at the point of care prevents a medical event from turning into a long-term financial disaster. The final stage of the life cycle occurs when the medical bill arrives and enters the debt collection ecosystem. Unpaid medical bills were once a primary driver of negative marks on credit reports from Equifax, Experian, and TransUnion. Recent industry changes have shifted this landscape. Now, any medical collection debt with an initial balance under $500 is erased from U.S. consumer credit reports entirely. Additionally, all paid medical debt is removed from reports, and new unpaid debt is granted a 1-year grace period. This gives patients 12 months to resolve billing disputes before the debt can impact their credit file. These rules decouple healthcare costs from your long-term borrowing power, ensuring that a medical dispute doesn't prevent you from qualifying for a mortgage or a car loan. When you look at the macro perspective, the U.S. healthcare system becomes less of an unpredictable hazard and more of a navigable financial landscape. The combination of pre-funded, tax-advantaged accounts and federal limits on out-of-network billing replaces unpredictable liabilities with a measurable financial ceiling for medical costs. Your first action item is to audit your health insurance documents. Verify if your deductible meets the IRS requirements to open and fund an HSA during your next enrollment period. Second, question every waiver form at a medical facility. Ensure you are not accidentally signing away your No Surprises Act protections for the sake of convenience. Finally, pull your annual credit reports. Confirm that any medical collections under $500 have been legally purged from your history. KFF research shows that medical debt often forces people to cut spending on basic necessities like food and clothing. Removing these surprise bills and collection entries eliminates a primary source of household financial instability. By treating healthcare as a managed component of a financial portfolio, women can navigate the medical system while keeping their long-term assets insulated from billing volatility.